So the format of the test is the same as the first test. You know, you'll have, I think this one has like 23 questions, but some have, you know, some journalizing that you'll do. So we'll kind of go over what to expect. It'll still have multiple choice as well. So we'll kind of talk about what terminology you might want to look over. So let's just start with chapter 9. You can still bring the page front and back of notes too. So you can use one page front and back of notes. And then of course scrap paper, calculator, typical stuff. Try to make sure you don't forget anything. And we'll have the class period test as usual. So we are covering chapters 9 and 10, which are all on, of course, liabilities. Chapter 9 focused on current liabilities. So some of the things I would look over in that chapter as far as terminology, I would know, remember we talked about unearned revenues being a liability, and we're going to do some examples here in a minute too. But make sure you know what unearned revenues are. Just know what a current liability is. What's kind of the definition of a current liability? When is it due, I guess would be the more.
Within 1 period?
Yes, yeah, current liabilities, very good, are liabilities that we pay within 1 year or the operating cycle. So you're looking at like short-term notes payable and sales tax payable, even like wages payable, and then of course we're going to deal with payroll taxes too and payroll expenses. So those are all current liabilities. Let's see. Know what like a short-term note is. You okay? That sounded painful. So know what a short-term notes payable is. You know, it's also called a promissory note. So I would know that. So short-term notes payable, promissory note. And we'll do examples on those. Let's see. And then know, you know, we'll talk about again like the payroll taxes, but know like your FUTA, the FUTA, and the SUTA, SUTA. Those are both unemployment taxes. Unemployment taxes paid only by the employer. So I would know that you know your federal and state unemployment are paid by the employer. FUTA and SUTA, so FUTA and SUTA. Sounds like I'm spelling out a bad word, FUTA. When you say it out loud, it doesn't sound so great. So those are both unemployment taxes paid only by the employer. The employer, if you remember, also pays FICA, the FICA, FICA taxes, which are Social Security and Medicare. So the employer pays unemployment, and then they pay Social Security and Medicare.
Can I ask a quick question?
Sure.
Why are all of the PowerPoints called Wild Fin Man?
It's Wild is the author of the book, and Fin stands for financial, and Man stands for managerial.
Oh. I thought
It's a valid question.
Clever name.
Yeah, I just made it up. I guess I should have said that, right? And they're like, yeah, that's my nickname. You know? So FICA is made up of Social Security and Medicare. Remember, FICA taxes are paid, again, the employer pays FICA taxes, and then the employee contributes as well. It's an equal contribution. They both pay in. So I would know that. You will be journalizing employee and employer payroll, so we'll talk a little bit about that in a minute. But again, the employee themselves pay FICA, the Medicare and Social Security, and then they pay like any income taxes, state, federal, local, you know, whatever they're responsible for, depending on the state. And then the employee might have voluntary deductions too, like health insurance or union dues. What's another? Donations like to United Way or Red Cross or something like that. So let's get into the fun stuff and do some examples. So again, when you're dealing with unearned revenue, remember that is when we owe them the actual product or service. So they paid us in advance. So just remember, how to journalize when we actually recognized unearned revenue and then when it becomes earned revenue. So if you remember, I forgot to bring another marker down or up. Yeah. I'm going to run and get, I just think you're resourceful. Like, what else do you have in there now? So again, when we're dealing with unearned revenue, when they first give us the money, whether it's for like a magazine subscription or ticket sales or construction, whatever they're doing, remember we take their cash and we create that liability unearned revenue. So, we would actually debit cash and credit unearned revenue for, let's just say $1,000 and make it easy. We'll say it's magazine subscriptions. So we sell magazine subscriptions, $1,000 worth, I don't know, March 1st. And so we recognize cash of $1,000 and unearned revenue of $1,000. Okay. And then say it's now the end of the year and we need to recognize how much of that revenue is actually earned. So it could be the full amount, it could be part of it, it depends on what type of subscription it is. So we're just going to pretend 700 of it was earned at the end of the year. So in that purpose, in that point, you're actually debiting unearned revenue and crediting your revenue, whatever account that may be, fees earned or magazine subscriptions earned, for the amount that's earned and turned into real revenue. So unearned revenue is a current liability. We generally owe it within 1 year. And then the next current liability that we deal with are notes payable. So again, in Chapter 9, we're dealing with short-term notes payable. So it's a note that we issued that's less than 1 year in length. The only tricky part is that you will see on the test, what if we issue it in like November or December, it's not due until the next year. Okay, so we did deal with those. So make sure, and we'll do an example, that number one, we need to be able to calculate interest on the note, the maturity date on the note, and then recognize any accrued interest at the end of the period. And then also pay it off. And then notes. So there's lots to do with notes, but again, it's the same as we did with short-term notes receivable. We're just the ones owing it now, so we just have to switch gears just a little bit. But as far as maturity date and interest, you're calculating those the same as you were before. So I'm going to get rid of this so I can get it all on one screen. So if we take out a note, let's say we do it on December 15th, someone issues us a note for $5,000, 4% interest, and it's a 60-day note. Okay, so it's $5,000, 4%, 60-day note. When that note is issued to us, say we borrowed money, we'll just assume we're borrowing money. What would I debit and credit when the note was issued to me? What am I getting? Cash. Good. So I'm going to debit cash, right? And what do I credit? Very good. Notes payable. For $5,000. Okay, so that's actually issuing the note on the 15th. We debit cash and credit notes payable. Okay. And then we would want to calculate, on this one, we need to calculate the interest due to the end of the year, right? Because we're going to have to recognize accrued interest on December 31st. Then we want to calculate our maturity date and what we're going to pay back in 60 days. Okay. So again, from December 31st, from the 16th through the 15th through the 31st, that's 16 days, right? So from the 15th all the way through the end of the year, we have a total of 16 days. So that's accrued interest that we need to recognize. Okay. So that gives us 16 days. We know we have 60 days total. So then we have January is 31 days. So that puts us up to what, 47 days? So this would come due 60 minus 47. February 13th would be the maturity. Okay. So we're going to recognize 16 days worth of accrued interest here. And that would leave us with what, 44 days of interest left? I'm just going to jot that down. And the next year, I know that's tiny, but okay. So again, we have 16 days that pass from the 15th when this was issued till the end of the year. So we need to recognize that as accrued interest that we owe. And then we're actually, this note is going to mature on the 13th of February. So we'll need to calculate, you know, the total interest and recognize the payment of that. So your journal entry on the 31st, what am I going, well, first we need to calculate interest, don't we? So our interest would be 5,000 times 4% times 16 over 360. So that's my interest. You can round to the nearest whole dollar if it's a fraction. 9? Just $9. So 5,000 times 4% times 16 over 360. So we had $9 of accrued interest in these 16 days. Okay. So when we journalize that on the 31st, what do I need to debit and credit to show interest accrued that we owe? And we're not paying yet. Interest expense, good. And what do I credit? Perfect. Okay. So interest expense and interest payable of $9. So that's at the end of the period. That's an end of period adjustment that we have to do. Okay. And then the last entry is actually paying this note in full when it matures, right? So it matures in another 44 days. So we need to calculate that interest. So that interest would still be your principal, 5,000, times 4%, times now 44 over 360 days. So what's my interest accrued in the next year? Or interest due? Jay, 24 or 44? 24? Okay, we'll round to 24 then. That sounds like a good, nice number. So $24. So what we need to recognize, or what we need to journalize now, is paying this note in full. Okay, so we're paying the full cash. Well, in this case, we owe 5,000 plus 9 plus 24, right? We have total interest of $33. Okay, total interest is 33. Okay. So when we go and pay this at maturity, we're going to pay them $5,000 plus the 33 in interest, and we're paying off the note, right? And we need to do the entry for the interest. Okay. So this would be on February 13th. Okay. Well, we know we're going to debit notes payable for the face value or the maturity value, or not the maturity value, the face value. The note payable, since we're paying it off, gets debited $5,000. Okay. We're now paying this interest, right? This $9 of interest. So we can credit interest, or sorry, debit interest payable. So interest payable gets debited the $9 that we're paying off. And then we debit interest expense for the expense of the interest we haven't yet recognized, which is $24. And then we credit cash for the $5,033. So we credit cash for the full payment. So again, just make sure you know how to do this adjusting entry at the end of the year. You know how to calculate interest. You know how to calculate maturity date. You know, you might see several questions. There might be one where you're just calculating the maturity date. There may be one where you're just doing this journal entry. So, you know, just know how to do all of that with your short-term notes payable. Are there any questions on notes payable? That one's, again, at least you've already calculated maturity date and interest. We're just looking at it from the payable side, okay? The second half that we really dealt with in Chapter 9, again, was dealing with your taxes. So we're looking at payroll here. So again, I already told you this, but you know, as a reminder, as far as the employer, what the employer is paying out of their pocket, they're going to pay payroll taxes expense, and it's going to be for FICA, which is Social Security and Medicare, and then the FUTA and SUTA, the unemployment. Okay, so they will give you the percentages on the test. You don't have to memorize, you know, that Social Security is 6.2%, Medicare is 1.45. They will give you those percentages, and then they'll give you percentages for unemployment as well. Okay, but just know, you know, when you're looking at the employer, they pay payroll tax expenses, and they pay FICA and Medicare on those. Okay, and FICA, Medicare, Social Security, and then FUTA and SUTA. So what that journal entry looks like, has everyone got this down? So we'll look at what that looks like. Okay. So from the employer payroll, so this is employer taxes. Okay. They're going to, you know, whatever, we'll just say it's like March 31st. They're going to pay a payroll tax expense. Okay. And from that, they're going to have FICA, Social Security, FICA, Medicare, and then federal unemployment, and state unemployment. Okay, and these are all payable accounts. Hence the current liability. Okay, so that's the structure of your journal entry from the employer payroll taxes. So we debit payroll tax expense, and then we credit the payables. To save on time, I won't, you know, come up with a number. I'll just put some fake numbers in. But again, you know, they're going to tell you, you're looking at calculating these off of the employer's gross pay. Okay, so if you remember, gross pay is the employee's earnings before any deductions or taxes or anything. So we're going to take their gross pay, and FICA Social Security is 6.2% of their gross pay. I'm just going to make up some numbers just so we can illustrate. Medicare would be like 1.45%. And then federal unemployment and state unemployment, again, they'll give you those rates, but I'm just going to make them pretty small. I think. Okay. Now again, those are no real calculations. But they'll give you the percentages to do. So you'll calculate, 6.2% of gross pay to get your FICA Social Security, and they'll give you those percentages. And then same for the others, they'll give you all the percentages. And so those get all credited to your payables, and you just add them up. What is that, like 190, 225? Yeah. And we're going to debit payroll tax expense for the total, okay? So you will have to calculate your credit amounts first. So calculate, I didn't give myself much room to put in my debit amount, but calculate all your taxes first, and then add them up and debit the total, okay? So that's the employer tax. That's what they're paying in taxes and payroll taxes. On the employee side, okay, so we also have the employee. On that same day, okay, we're going to debit salaries expense or wages expense or whatever they tell you for the employee's gross pay, okay? So let's say their gross pay is $2,000. That's gross pay. Okay, so we debit salary expense for $2,000, for example, of their gross pay. So that's how much we pay them their salary before we take out anything. They are also going to pay FICA Social Security and FICA Medicare, okay? Again, I didn't actually do them. I guess we could actually do the numbers. That way it's a little more accurate. These won't match up, but at least you'll get an idea. So you would actually take their gross pay times 6.2%. And that would be, what, $124? Okay. And then I would take their gross pay times 1.45%. I was really close there. $29 on FICA Medicare. And then from there, if whatever other withholdings or deductions they have, you'll probably have at least federal income tax. Which is usually some percentage, they'll give you the percentage. We'll just say that's 200. Okay. And then they might have other withholdings. There could be state income tax. There could be health insurance. We'll just do health insurance just for fun. There could be insurance dues union dues, any type of voluntary, okay, whatever we're deducting. And they'll give you all that information. And so then we would just take their gross pay, the $2,000, and subtract out all the withholdings. We should get 1,597. Okay, 1,597. And that would be a credit to salaries payable. Okay, so that's what we call their net pay. So I would know that definition too. Net pay is the actual pay they're receiving. So their gross pay minus all of their withholdings and deductions. Any questions on payroll taxes or Chapter 9 stuff in general? You guys still pretty comfortable with that? Okay. So that's Chapter 9. Again, that's all current liabilities. So when we move into Chapter 10, I think Chapter 10 is probably the harder chapter. You're dealing with bonds, right? So with bonds, Chapter 10 really is total about long-term liabilities. So again, current liabilities due within the current year or operating cycle. The flip of that, we have long-term liabilities that are obviously going to be due beyond the current period. Really the two we're dealing with in this chapter is going to be bonds and then installment notes, okay? So we have bonds and then installment notes. So let's talk about those. Everybody have this stuff? Okay. Okay, so bonds, super fun, right? Everybody loves bonds. You won't be doing like the amortization tables on the test. I know you're like, but you will still want to know how to deal with bonds. So we'll talk about exactly what you need to know for the test. So first, the first thing I would know, you'll probably see some multiple choice on this, is just what the different type, how we sell bonds, like at a premium, at a discount, at contract, or at par, I mean. So when we sell a bond at par, that means that basically our stated interest rate equals the market rate. Okay. So when we sell a bond at par, it's the easiest, right? When you issue a bond at par and you calculate, everything's pretty easy, okay? So if a bond is issued at par value, that means the stated interest rate equals the current market rate, so we don't have to discount or put a premium on the bond. So truly, it's pretty easy. So when you issue a bond at par, let's just look at, we'll do a $10,000 bond. Let's do a 5% interest rate, and we'll just make it short. We'll do 2 years, just for fun. Okay. So if we have a $10,000 par bond, a 5% stated interest rate for 2 years, we're going to, and then all of your examples on the test, you'll still stick with, you're making semi-annual payments. So, every 6 months. So when you issue that bond, I guess I could give us a date, on February 1st, then you're going to just receive the cash and credit bonds payable, right? So cash is credited for the $10,000, and then you're going to have bonds payable of $10,000. Okay, so issuing at par is pretty straightforward. When you pay interest, and you're going to pay interest every, June 30th and December 31st, you're going to calculate interest on a bond. It doesn't matter, if you remember, it doesn't matter if we issue it at par, at a premium, or at a discount, we calculate interest the same, okay? So interest on this bond is always going to be $10,000 times the semi-annual rate. So we would take 5% divided by, I'm doing it in my head there, divided by 2. Okay, so your interest is $10,000 face value times your semi-annual interest rate of 2.5%. Okay. So what's my interest on this bond? 2.5% of 10,000. $250. Thank you. Okay, so $250 of interest every 6 months, in this case just for 2 years. So when we pay interest on a par bond, we're truly just debiting, you know, like your bond interest expense, right? And then crediting cash. So bond interest expense gets debited $250 and cash gets credited. And we'll just assume that's, you know, at the end of the first period there. And then when this bond matures in 2 years, remember, what are we going to pay back? I think I heard someone say we're going to pay back the face value of $10,000. So, you know, in 2 years when this bond matures, it's February 1st, 2 years from now, we're going to debit bonds payable and credit cash for the $10,000. Okay. And again, it doesn't matter how the bond is issued, whether it's at a premium, a discount, or par. That is always your payment on the bond when it matures. You're always just paying back the face value. Okay. Any questions on par bonds? They're pretty easy, right? I mean, you're just calculating interest. Let's talk about discount then. Okay. So we discount a bond when our stated interest rate is less than the market rate. Bless you. And you may hear it called, instead of stated rate, you may hear it contract rate, same word. Okay, so we discount a bond when the interest we're offering is less than the market rate. So we're paying them less interest over the life of this bond than what the current market is. So we're going to discount it to make this bond more attractive. So in this case, say it is, you know, 5%, we're offering 5%, the market's like 6%. And they'll give you how much to discount it. You know, you won't have to come up with that. But say in this case, we sell it at like 98%. Okay, so it's the same bond. It's still 10,000, 5%, 2 year, but it's issued at 98%. Okay, so if we issued this bond at 98% of its par value, how much cash would we receive on that bond? 9,800. Yeah, we truly just take 10,000 times 98%. So the cash we receive is 9,800. Okay. So we've discounted this bond $200. Okay. So our discount on bonds payable is $200. So that gets debited. That discount on bonds payable gets debited. And then we're still going to credit bonds payable for the full 10,000. For the full 10,000. So that's what issuing at a discount looks like. So that's not too bad. The interest payment is, when we recognize interest, that's where it gets a little tricky with these bonds issued at a discount or a premium. Okay, so if you remember, we're still going to pay them. This is still a 5% bond, so we're still paying them the $250 of interest that we already calculated. That is how much we're paying them in cash. Okay, but if you remember, when we debit bond interest expense, That's for the interest and the amortized discount. Okay. So we're going to leave this here for now. So we're going to have to credit discount on bonds payable, and we're going to credit cash. Cash is still credited, the $250 that we're paying in interest. Okay, so cash is still $250. But we're going to take that bond, and what we're going to do is amortize. So you want to know what that word means, amortize. Just means spread out the discount or the premium. Okay, so we're going to amortize this discount. Again, you won't have to do the table and all of those things, but you will take this discount is $200 total. We're going to spread it over the life of the bond. Well, if this is a 2-year bond, how many interest payments are we paying? 4, right? Yeah, we're making 2-year payments times twice a year, so 4 total payments of interest. Okay, so we're making 4 total payments. So to amortize our discount, we're just going to take the 200 and divide it by 4. Okay, so you take your discount amount, divide it by total payments, and we're going to recognize $50 of the discount every time we make an interest payment. Okay, so I credit discount on bonds payable. That discount's being spread over the life of the bond. And then I just add these two together to get my total bond interest expense. Okay. So when you have a discount, your bond interest expense is your amortized discount plus your interest payment. So you just take your discount amount and divide it by your total number of payments to get how much of that discount you want to credit or recognize or amortize, however you want to look at it, every period. So that's really the tricky part, right? Then when that matures, you're still going to do a debit to bonds payable and a credit to cash at $10,000. That doesn't change. You're still paying back the principal amount when it matures. Any questions on discounts? Is it making sense?
What is the change those to for total?
What that means is we have to calculate how many interest payments we're making over the life of the bond. So since we're making 2 payments a year and it's a 2-year bond, that's what I got that for. Yeah, good question. The 2 payments a year are standard. I made up the 2-year. So yeah, they'll tell you how many years the bond is, and then you'll always multiply by 2 to get your total payment. So it'll always be, these are good questions, these will always be what we call semi-annual payments. So it doesn't matter how many years they tell you, to get your total payments, just always multiply the years by 2. Okay? Yeah, to take your discount divided by your total payments to amortize it. Yeah. You guys have any other questions on that one? All right. Well, let's look at the premium side of things. So our other option is to sell a bond at a premium. That's when our stated rate is higher than the market rate. So when we're offering a higher interest payment than the current market rate, they're going to give us more cash up front for this bond, okay? Because we're paying them more interest than they could get in another investment. So if we sell at a premium, that means our stated rate is greater than our market rate, okay? So let's just look at the same bond, just to make it easy. So here, though, we're going to issue it at 102%. So we're, again, going to get more cash up front for this bond because we're selling it at a premium. Okay. So how much cash am I receiving? A 10,000 bond issued at 102%.
10,200.
Very good, 10,200. Okay. This time I'm going to credit premium on bonds payable for the premium amount of 200 and credit bonds payable the 10,000 par value. Okay, because again, we always pay back the par value when it matures. So cash gets debited for 102% or 10,200. Premium on bonds payable gets credited 200, and bonds payable gets credited 10,000. Okay. So that's issuing a bond at a premium. When we recognize bond interest expense on a premium, they're paying us an extra 200 cash up front. That actually reduces our total interest expense. Where the discount increases our bond interest expense, a premium reduces our total bond interest expense. So what that would look like lots of writing here. Again, your interest calculation is still the same. I know I erased it, but we took 2.5% of 10,000. So that was $250 in cash payment. Okay. So we paid them $250 in interest, just like we did over here. We're still going to figure out, we're going to amortize that premium. Well, it's really the same. It's the same amount on this one. So again, our total payments, if it's a 2-year bond and we're paying twice a year, we still have 4 total payments. Our premium is $200 divided by 4. We still have, now we have a $50 premium to recognize every period. Okay, so we are going to debit premium on bonds payable, the $50 amortized amount. Give myself much room there. And to get my total bond interest expense, I'm going to take my cash minus that premium. So my total bond interest expense with a premium is $200. And that's because, again, they gave us $200 in cash up front, more because we're paying them a higher interest rate. So we spread that premium over the life of the bond, or we amortize it. I keep saying that word. It's kind of a fun word. Okay. Again, you won't have to do the tables where you calculate and show the carrying value and the total discount or amortization, but you do need to know how to issue it and how to handle one payment of interest. And then also know it's discounted when our stated rate is less. We sell it at a premium when our stated rate is higher. So know that. If there's anything else with bonds. Interest due, total interest expense, amortizing it. I think that's everything on bonds. It's just that much, right? No big deal. Are there any questions on bonds in general? You guys understand amortizing the discount and the premium and issuing the bonds, the total payments, all of that stuff? It helps if you put the stuff in your notes, it really does help, obviously. When you get to the test, it's like, oh yeah, no. You don't have to memorize it. I know it's kind of tricky, but you'll still have to be able to calculate it. Alrighty. Well, the last thing that you'll want to know for the test is how to deal with installment notes. You will not have to use the present or the future value of an annuity. You won't have to look at the tables. Okay, they'll give you a payment amount, and if you remember on installment notes, you're making equal payments, right? Whether it's a yearly, an annual payment, or a monthly payment, you're paying the same amount every month. And a different, you're going to have some of it going towards the principal and some going towards interest. So really just understand what an installment note is and be able to calculate the interest. So if they give you, they'll give you like the payment amount and the interest rate. So you'll be able to calculate it. Okay. So just review that. I don't think they have you calculate I think you truly just have to calculate the interest. But just know what an installment note is as well. Okay. So I would just review that. Again, you won't have to set up the table. You won't have to show the amortization. So you just have to calculate interest on like the first payment, which is just principal times the interest rate as a review. It's pretty simple. I just want you to understand installment notes. I mean, honestly, there's tools out there that do all that for you. So as long as you understand what it's doing, I'm happy. Yeah, on the first payment. So it'll just be principal. If it's an annual payment, it's just truly principal times interest rate. Yeah. I think it's an annual payment. If it were monthly, just remember to take your annual rate divided by 12 to get a monthly interest. Okay. I think that's really the only tricky part of installment notes is when you're converting them to monthly. Otherwise, you'll have really high monthly payments or interest if you calculate on the annual interest rate. It'll be your interest rate divided by 12. You'll take principal times your interest rate divided by 12 if it's a monthly payment. Yeah. And what that does in essence is just give you a monthly interest rate. Yeah. But I think it's annual. So, just review, just to make sure. But I think they give you an annual payment. So you wouldn't have to divide by 12. Yeah, principal times interest rate. You guys have any questions on the test? Feel free to. Like I said, just review terminology a little bit. There's, several terms in these chapters. Just so you're not surprised. I think we went over the bigger term things, but just to make sure, sometimes how I say it is different, I know, than the book says it. So it doesn't hurt to look over that. The PowerPoint's a great review, really. Just go through and read those terms. If there are no questions, y'all have a great day. Be safe out there. Hopefully,
Thursday, and we don't have class next week.
Correct. Yeah, as a reminder, we will not meet next week at all. So.
Yeah.